Welcome back, Half Hunters. It is a very terrific Thursday. I'm going to talk about something a little bit here in just a bit. Let me get through these 5 ETFs, and I want to bring up something very important. But TradingView had a data issue this morning, and I'm going to talk about that here in just a bit. But we did have a nice little gap up this morning. Let's see, roughly about a third, a little bit over a third of a percent there on the SPY. We didn't really do much yesterday afternoon. And yeah, I mean, there you go. We'll check and see what we did in the early market hours there. You can see nice little pop there from the data that we did get this morning, which was the core PCE came in flat for forecast. Forecast was calling for 0.4%. Actual came in at 0.4%. Apparently the market really liked that. I think the market more responded to, because that was kind of a flat number. I mean, maybe the market was positive or like that, but the personal income month over month was up 1% compared to the forecast of 0.4%. And that's not exactly great for company margin pressure, but as far as, consumers, hurting on money and whatnot, that's obviously that's not a bad look there. Getting paid more. Personal spending though, personal spending was also kind of flat at 0.2% from forecast. So there you go. So personal income up pretty good amount. Personal spending kind of staying flat from forecast. So I mean, obviously, then you expect the consumer to actually just be better off right now. So there you go. That's kind of the way the data came in this morning. But you can see very nice strong pop there this morning from that. Qs also got quite a bit. Take a look at the Qs real quick. Boom. Strong pop there. Very strong pop there on the Qs. So, yeah, there you go. At least that's kind of how the way it's looking today. Nice little gap up. Kind of just traded back. Kind of retested lower. Got negative. And then that was kind of it. And then we started to bounce. Kind of like we have been over the past 2.5 hours or so. Looking pretty good. Okay. Qs, same kind of deal. Nice gap up. Kind of pulled back here, bounced once we got negative, and boom. Then been pushing higher. IWM, nice gap up. Up about 0.75%. Same thing with about the Qs. Nice pullback here. Has not broken that 205, 204, 206 area. So, Qs kind of rejecting out of there, but it's kind of knocking its head up there. So maybe it will eventually break through that level. The DIA, the Dow Jones Industrial Average. So, not much else to say. Gap up, pulled back. It hasn't really bounced as hard, kind of like the IWM. Hasn't really bounced from that low as much. But not bad. I mean, it's basically flat. The RSP looking pretty good here on the RSP. So we've seen that they're continuing to see that broadening out there on the RSP side of things. Nice gap up, pullback, and it has traded higher pretty good. So there you go, up 0.5%. Yeah, RSP looking good, man. RSP, seen that broadening out. I still like to be diversifying away from the Qs. I still very much like that approach to things. And you can see the DIA here doing pretty good, kind of just retesting into that 10 EMA today. Nice gap up. Probably just continues to grind higher. Nothing crazy. IWM smacking its head into this level. We actually did take out the high from back in December there on the IWM. So that looks really pretty good. Looks pretty good to me. Any kind of quick pullbacks, I'd be bullish. I'd be bullish. Qs, look at that quick snapback right down to this. That's some. This is gonna be something you're looking for on the IWM. If you get something like that on a day where you get a quick pullback, I mean, you're just gonna be buying it up. Qs looking pretty good, pulling back to the 10 EMA. If you want to be very tight on protective stops, I mean, I could say, hey, right there, right below yesterday's low, because we're getting the bounce, right? We finally are getting the bounce after this pop that we got from NVIDIA's earnings. Had kind of like a 4-day pullback in a sense. We had continuation well, we continue to pull back a little bit this morning, but we're bouncing here. So to me, it makes sense to kind of maybe move up an alert or stop losses, or maybe even partial stop losses. Maybe just take 50% of it and say, hey, you know what, I'll put 50% of it here, and you leave 50% of it down at the lower levels. That's fine, but I would at least have an alert here for now. That's just kind of the way I would think about it. Very definitely, clearly getting the pop continuation today. Same thing with the SPY. You could definitely say, hey, you know what? I'm gonna move the stop under the lows previously here. I would say I'd be much more willing to move the Qs kind of up to that level, because if they roll over, they're going to roll over harder than maybe the SPY will. So I would imagine the Qs would break down first, and they would take the SPY with it later. So you definitely see that on the Qs price action. So I don't think maybe you don't have to do it here on the SPY. Maybe you still kind of leave it at this lower level. So SPY, not doing too bad today, up 0.25%. So one thing I want to talk about real quick, though, since we just kind of talked about all of those, it is very important to have data from different services. This morning, TradingView was having an issue with the Qs. The Qs was actually trading like 5 points higher on the change and the percentage change was calculating like the change was 5 points higher. It was like, instead of this two, you can see it a little bit bigger down here, this 2.84 number, it was like 7.84 or 7.88 now, and the percentage change was kind of calculating off of that. And I was like, really, the Qs is up that much, and then the SPY and the RSP are not up as much. And then I was kind of noticing the IWM maybe had a little bit of issue with that. Yeah, no, they probably didn't. The IWM was actually just trading up that high from the gap up. But the Qs definitely had a little bit of that issue. And I was like, that doesn't make sense. And then I looked in, at the chart, and then I could see that now we closed at like 235, 28 or something like that. We were at like 238, so we weren't even up 7 points or whatever, or whatever the change was saying we were up. So that's why, it's very important to say, hey, something doesn't smell right. Let me check my other source of data and see if something's amiss here, and go from there, because the broker did have it right. And then I was kind of hoping actually TradingView was going to lead, or the mistake was going to be there when I did the live stream, but they actually fixed it about 2 hours, I guess, into the trading day, or 2.5 hours into the trading day. I mean, the browser just refreshed, and I noticed the Qs was updated, so they probably they got it fixed. So I mean, at least they got it fixed. Sometimes like there's issues that last a whole day, but it's still annoying when it happens. That's why you need to have multiple sources of data when you're dealing with the markets, because you don't want something that you're seeing which isn't correct impact a decision that you're making. Okay. So let's just kind of continue to run through some things. VIX dropping off pretty good today. All right, VIX, nice little drop there from an open higher open there. Okay. Dollar bouncing. Wow. Okay, so dollar actually was down. Oh my goodness, dollar was down earlier. Wow, to start the day. Wow, it has staged a comeback. I don't know what that means. I think it means comeback in Eastern European. But yeah, this is starting to look really good. Definitely looks like we've had a very nice pullback here for the second month of February. Nice basing action here towards the end of February. Looking really good. I'm curious what that looks like on a monthly. Not looking too bad. I mean, you can see here a monthly kind of time frame. We pulled back to this level from that false breakout that we did, or false breakdown that we had last July. Had it we pumped higher, kind of pulled back to this level, but still kind of just in this area. Be curious to see what happens here. Here's a look at the weekly. I mean, we could definitely just be basing down here. Maybe we push higher. Possibly, even just roll over here. Be interesting to see how this kind of goes, but I mean, here on at least on the way the daily looks, it looks pretty good. Maybe we continue to push higher here over the next week at least, and then maybe we see what happens. If we immediately turn over next week, we're probably just heading down to this line, at least this support level. That's the way I kind of look at that on the DXY. GLD, look at that. So the dollar staged at reversal since the morning, first hour into the day, kind of bottom, took off there. GLD though is up, so this is why I've been saying it. You just want to be bullish on GLD. Any kind of pullback, we got a pretty good one here a couple weeks ago. You just want to continue to be bullish in gold. It has periods like this where it's like DXY, the dollar, it's kind of a strong day, and then the gold's also up positive, and gold's having a pretty good day. That's a pretty good day for gold. You would think that the dollar was down, and that's kind of telling you how bullish gold is. So I would just continue to be bullish on gold, continue to be buying 80 dips. 10-year yield dropping off today. I was kind of curious on what this would do if we got the data. Once we got the data, I mean, the data came in flat, and I'm talking about the core PC. Kind of came in flat. I mean, it was we were up a little bit before, and then we got the data and it dropped off. And I wouldn't really say that the core PCE number was disinflationary, I guess, but it kind of seems like the market seems to think so. I don't really think it was disinflationary all that much. I mean, it's still increased by 0.4%, so it's not exactly a fantastic number. But 10 and 2 inversion here, just kind of hanging out, not really doing too much there on the 10 and 2 inversion. HYG, throw a little bit of an upper wick also into that 77.5 level like it has before. Pretty good spot to probably look to go bearish. We've rejected down to there a few times. Kind of got this kind of a little bit of a pennant pattern here over the past couple of weeks, kind of rising lows. Not a bad spot to maybe look to be bearish, but I wouldn't be aggressive on it. I'd probably have a pretty loose stop loss, maybe up above the high that we had back in December. Small position. It's an aggressive spot, so I'd be definitely a little bit less leveraged. Because if we roll over and break down, then you could probably add to it. But if we continue to pop up out of here and we don't reject off this level immediately, I would just say take it off the table, look for another spot, or maybe just flip it and go bullish. LQD, nice little upper wick here. Okay, hasn't really broken trend, but starting to look somewhat decent. TLT starting to look pretty good here. All right, TLT looks like it is trying to base again. Okay, not looking too bad. Not looking too bad there for the TLT. That's about how it'll close for the month. So, yeah, maybe we do look kind of bullish going into the next couple of months here on yield. So maybe we'll see yields drop off. Or bonds look somewhat decent to be bullish. Maybe we'll see yields drop off. All right, let's take a look at sector performance, sector rotation. Okay, here we go. Sector rotation for the day. Second day in a row. Real estate leading. All right. Tech also performing pretty well. Makes sense. Qs are doing pretty good today. Materials doing pretty good. Communications also outperforming. Energy's outperforming. Okay. Underperformers. Industrials, utilities, and discretionary is kind of all right there, just barely underperforming. Staples, financials, and healthcare underperforming. If we take out the gap, this is what we got. We got healthcare underperforming, Staples Financials, communications, discretionary utilities, all out underperforming, as well as the energies, barely, just a little bit. You got materials, industrials, tech, and real estate outperforming. Uh, you saw the middle part of the morning when we were getting the rollover action down to the lows of the day. The energies, XLE was actually doing pretty good during that time period. So this is a 12-month look. That's that's the only thing that's going to kind of stink about this is gotta do 6 months now. So I'm not gonna be able to do it less than. That's kind of a bummer. They only have this in a yearly format, which is really kind of a bummer. That is really a bummer. What I what is kind of interesting to know here or kind of look at. So we had a large unemployment rate increase back in the GFC Great Financial Crisis. It jumped all the way up to about 10%, 9.9%. You can see it. The one that corresponds to the teal line is on this right page. You can see 3.5%. It's colored teal there. Orange line corresponds over here, and then the blue line corresponds to this number system right here. So what I wanted to kind of look at, man, I wish we had data less than like a year, maybe like 6 months or three months. But what's kind of important to know is with unemployment rate being as low as it is, like historically low, like we're going all the way back to like late 60s style low. And, you know, whenever you kind of have that time period, what's the huge issue with having a really low unemployment rate is it's very difficult. If unemployment increases, what winds up happening across these three metrics here is when you have an increase in unemployment, well, your GDP, typically you're in a recession or about to be in a recession or something like that, you get the GDP, the debt to GDP number that actually goes higher on the relationship. Okay. And the reason why that is well, unemployment goes higher. You're kind of in a recession, which means your GDP number, which will increase the debt to GDP ratio because the GDP number will go down. That would push this ratio higher, and this is already basically at like some all-time highs, right? I mean, we're already at like all-time highs on that number. So that one's not good, right? If that was to happen, if we do have a recession anytime soon, here over the next year, we see this debt to GDP number go higher, and that kind of creates an issue because now you're talking about having to pay back more debt with less economic activity, or even the same amount of debt with less economic activity, which then would bond owners and purchasers like that, or bond traders, bond investors like that. My guess is probably not. We would probably continue to see yields increase, which would be the yellow line, orange line, whatever. So this is kind of the one thing that I would say I would be wanting to keep track of over definitely over the next year, and the probably the most important part of it, and why I keep talking so heavily about jobs numbers and yields. This is why. If if we start to see layoffs and start to look like we're going to go into recession, we'll probably see yields tick higher because, well, U.S. debt to GDP would go higher, which I don't think bond investors would like that. So they would send yields higher because they'd probably be cutting their exposure to U.S. debt. So anyways, that's just something I wanted to kind of look at. I didn't know how this chart would look. We kind of put this in. I really wish they didn't just have 12-month chart.